guys. So today we are going to talk about stock analysis and diving deep into them. Now let me tell you one thing before that stock analysis of two types: technical analysis and fundamental analysis. Now technical analysis doesn't talk about the company and doesn't talk about the business, and we don't get to know about the industry or anything related to the business. What this technical analysis does is that it observes the chart. It observes the chart of the company, whether it's going up and down, and depending upon a pattern, certain pattern and certain mathematical formula and certain mathematical tricks, it identifies whether the stock will go up or down, and that is basically technical analysis. Whereas fundamental analysis, you have to dive deep into the company, you have to know about its business, you have to know about the industry, you have to know about the management of the company, you have to know about whether the company is making a profit or not, and all these things. Now, how do we do fundamental analysis? Let me tell you one thing. In the previous video, we had already started fundamental analysis. Yes, we had taken the first step. Reading an annual report is the first step of fundamental analysis. Now, I taught you about how to read an annual report in the previous video itself. Over there, we learned about a letter to the shareholder and financial performance of the companies, along with that management analysis portion. And then in the end, we talked about financial statements, but I didn't tell you how to analyze those financial statements. So from now on, for the next few videos, we'll be learning about those financial statements and how to analyze them. So first of all, I'll be telling you how many financial statements are there. I'll be telling you the terms in those financial statements, and then we'll be knowing how to analyze those financial statements. How do we see that whether these are good financials of a company or whether these are poor or whether this is something fishy, right? And yeah, one more thing. You don't need to be an accountant to read financial statements and analyze them. Let me be clear about this. I'm an engineer myself and I know them pretty well, or at least a little bit. So yeah, you don't need to be an accountant. Then to the next question. How many types of financial statements are there? There are three types of financial statements. Income statement, which is also called profit and loss statement. Second is balance sheet. Then third is the cash flow statement. And over here we'll be beginning with the income statement, or which is called the profit and loss statement. First of all, I'll be telling you about the terms in the same, like revenue and depreciation, amortization, purchase of stock in trade. All these terms I'll be telling you in this video right now, and then in the next video we'll learn about which how much increase in the revenue is good, how much increase in inventories is good, and all these things. So let's begin with income statement. So first of all, profit and loss statement is divided mainly into two parts: income and expenses. Income, as the name says, that the income that the company generates by selling its products, and expenses, the expenses that the company has to pay to make its products or some other things, right? So under income, the first thing that comes is revenue. Revenue is the amount of products, not the amount of money generated from the products it sells. Now let's take an example. Let's assume that I have a company which sells bicycles, and the cost of these bicycles are 1,000 rupees, and I sell 1 lakh bicycles in 1 year, in one financial year. So it's pretty simple that the revenue would be 1 lakh into 1,000 rupees, which will be 10 crore rupees, and this will go under revenue, right? Then comes other income. What is this other income? Now it's possible that after selling my bicycle, some customers will come back to me and they'll ask to add some more features into that bicycle, like they want their brakes to be installed and some other gears and better features in the bicycles, right? So all these things will come under other income, and it's even possible that the bicycles might have been broken. Because of that, they asked for a service, and all these things come other income. But if you want to know what are these other income for any random business, what you do, you go to this area, note 15. These are not just random numbers, 10 and 15. These are notes, or what is called schedule. What happens is, after these financial statements, these three financial statements, you'll find notes in the annual report itself. Note 1, note 2, note 3, and so on. So you go to note 10. From there you can find how the company generates its revenue, what are the products by which it generates its revenues. And from the same, go to note number 15. From there you can check which services the company is selling, or whether it's selling services or not, and how it's generating the other income. So these are pretty important. You have to, like, wherever these notes are given, just go over there and read, and get just an in-depth analysis of where the company is spending and where the company is earning from. Now coming to the expenses part. So in expenses, it's pretty simple that whatever the company buys in order to make its product, those will come under expenses. So first of all, cost of raw material, as it says, the raw material that is required to make the product, and the cost for that comes under it, that comes under expenses. Then the second is inventories. Inventories won't be exactly under expenses, but the term is used, so I'll explain that. So inventories is basically after one financial year, that means at the end of 31st March. Now the company won't be able to sell all its products, right? From these 1 lakh bicycles, let's assume that I wasn't able to sell 1,000 bicycles. Okay, so these are the inventories. Inventories is just basically the finished products that the company has not been able to sell at the end of the financial year. That's it. So the next term is depreciation, and depreciation is a pretty important term if you ask me. And if you are not an accountant, or you have not done accounts, then you won't be knowing this term. So let me give you an example and explain this term with an example. Now let's suppose my company generates a revenue from selling these products. Let's take another example, not this bicycle one. Now look, what basically happens is that when you buy a machine, suppose a company buys a machine, and it can last for the next 5 years, right? So what the company will do is that instead of showing the whole expense of the machine in just 1 year, it will show it in the next 5 years. Like, I buy a machine for 1,000 rupees, and it's likely to run for the next 5 years. So I'll divide 1,000 by 5, 200 rupees every year. It will show expense in this manner rather than showing 1,000 rupees at one go. The main reason why this is done is just because of accounting principles and all. Nothing much special. But if you want to look this from an investor's point of view, and how an investor can benefit from this, you can take a look at this example. Suppose a company makes a profit of 10,000 rupees, and the machine's cost is 7,500 rupees. So the net profit will come out to be 2,500 rupees. Pretty simple, right? But now what happens is that company, the investors looks at this profit, and he's pretty much disappointed that 2,500 is not a good profit for a company, and it won't be able to last for the next few years, right? So that's why what the company does is that it will divide this 7,500 into 5 separate years, right? It will show this in next 5 years as 1,500 in 1 year over the next 5 years. So the profit of the company for this year will become 10,000 minus 1,500, which will come out to be 8,500 rupees, right? So this is the profit that will be shown in the annual report, and by looking at this profit, the investor would say, yeah, this is a good company, and the company can last for the next couple of years pretty easily. But there's another problem. Now, suppose the company has a loan, has a debt, it has borrowed some money from the bank and it has to repay. And let's suppose this debt is 8,000 rupees, but the company has only 2,500 rupees in reality, right? Whereas it's showing 8,500 rupees to its investor. The investor will think that the company will easily pay off its debt because its profit is much larger than the debt, right? But the reality is that the company has only 2,500 rupees in cash. So all these things are told in the cash balance, in the cash flow statement of the financial statements. And over there you learn that the cash flow statements are like a bank balance of the company, and I'll tell you everything over there. So moving from depreciation, I hope you understood it. We'll move to employee benefits. Employee benefits is nothing more than the wages that are paid to the employees and the bonuses that are paid to the employees. Some gifts might be given to employees, something like this. All these come under employee benefits. So these are expenses, obviously. Then comes CSR expense. This is not important. This is just a compulsory type of thing for each company that according to Companies Act, they have to expend some amount of their profit in CSR. CSR is consumer social responsibility. Okay, so it's basically like social services, and the company has to compulsorily do this, and that's why they show this expense. So it's pretty much irrelevant. Then after this comes the profit. Income minus expense is the profit, right? After this profit, the tax is reduced, right? Which is called current tax, normal tax which you might be paying at home, right? So that tax is reduced from the decreased from the profit, and you get a profit after tax. This profit, which is before deducting the tax, is called profit before tax, or in short it's called PBT, right? And after reducing these tax, it's called profit after tax. Now another term, deferred tax. What is this deferred tax, right? This is a tax that the company might have to pay in the future. Now a question might come, why will a company pay tax in the future? Why does a company need to pay tax in the future, right? So actually there is no problem with the company in this case. What happens is, when the company is depreciating this value, suppose it depreciated this machine for 5 years, so it is 1,500 per year, right? Whereas the income tax department says that you can't depreciate this for 5 years, you have to depreciate this for only 3 years. And due to this difference, the company has to pay the income tax has to pay tax to the income tax department in the future, or some legal procedures are there after which they might have to pay tax, so they include this under deferred tax. So after this you get the profit after tax, and that pretty much sums up the income statement. So from the next video onwards, we'll be seeing how the income statement has to be analyzed. We'll take an example of a company and then decide whether that income statement is good, whether the company is profitable, how these various factors affect the company. All this we'll be analyzing in the next video. So till then, stay safe.